Welcome back. The president announcing this bipartisan tax deal last night, and under the terms, the Bush-era tax cuts would be extended for 2 years, and jobless benefits would be renewed for another 13 months. Here to discuss that and a lot more, a lot of implications this morning, David Malpass is president of Encima Global and chairman of GrowPac, a group critical of the Fed's asset purchase program. And Kevin Carone is market strategist over at Stifel. Nicholas also joins us from New York. Guys, good morning to both of you.
Morning.
David, this is going to have an impact, and some say at least for 2011 it will boost the economy to the upside, right?
Well, there's money flowing from all spots of Washington. So you've got the Fed putting out money. You've got trillions flowing to all parts of the economy. No one said in this deal we can't afford it. So we still have to get over that hurdle going forward. Also, what happened yesterday was the president basically announced his re-election campaign. You know, his remarks were scathing of the Republicans. And so he's perfectly positioned because he's got Democrats from his left saying that this isn't, this is too generous to the rich, when you've got a huge extension of unemployment insurance, which from an economic standpoint just doesn't help jobs. Small business jobs aren't helped in this bill. It's a huge, long bill, very complicated. It'll be interesting to see if members get to read it before they actually vote on it. I would have rather seen them do small bills and make individual decisions at some point in saying we can't afford it to some kind of earmark that's in this bill.
Will it boost aggregate demand or not?
Oh, I don't think it boosts aggregate demand because the private knows the money is so as Washington spends more money, and this is a big spending bill, let's make no mistake about it. As Washington spends more money, small businesses across the country have to be cautious on hiring. It won't break. You didn't hear the president saying the goal of this bill is to give people confidence that we're going to have a market-oriented economy. He didn't say that. He said over and over again, I didn't want to give money to the rich. That was his theme last night in his remarks.
But Kevin, I mean, people are going to notice at the beginning of the year where they normally see the bite of payroll taxes taking some money away from them, that they're going to notice that that's still in their paycheck. Is it not?
Well, I think that they're going to notice that there's going to be no meaningful change going forward as far as the marginal. You're not going to see a drop in the marginal tax rates. You're going to just see what you have now going forward as far as that piece is concerned. Beyond that, I agree with what David's saying, that when you look at the overall deficit, I don't see a much smaller deficit here. And in 2011 and 2012, you've got deficits in this country that are going to be maybe double that's projected for Europe, for example, who are struggling mightily to get their deficits down.
No, I'm not arguing that the long-term problems are not addressed. Right. I'm just wondering, short-term, will this give people confidence to spend, even irresponsibly, even if it's not healthy for us long term?
Yes,
does it give the economy and the markets a shot of steroids?
Yes, I think in the short run there are some positive elements of this. I think it is better that we have this in place for aggregate demand than if we were to increase taxes, and then whatever occurs on the investment spending side, whatever comes by way of investment tax credits or improvements in the marginal efficiency of money being applied on the investment side, that'll be a positive directionally. But I think we have many other big challenges, as David talked about.
But we have to remember we have QE2, that's a $600 billion program by the Fed to buy Treasury securities. That's going to end in June. And if the Fed doesn't go with QE3, then come June, we as a country are going to have to finance not only the deficit we had anticipated, but this extra $500 billion a year from this program. So it's going to be very dicey in the fixed income markets.
We haven't seen what the scoring on this bill is. Jim's $500 billion was a number in the Wall Street Journal yesterday, but I think once they score this, if they ever release it, sometimes they don't tell you what the scoring is before they ask the members to vote on it because they don't want to know how much it's going to cost.